Welcome to The Explainer. I've got my sharpest financial analyst hat on today because we are taking a deep, highly skeptical dive into the true financial realities hiding right behind the massive hype of these upcoming AI IPOs. Now, we keep hearing that artificial intelligence is the definitive technological revolution of our time. And hey, maybe it is. But when we actually look at the numbers, the balance sheets, the structural risks being quietly packaged and sold to the public, well, a very different story starts to emerge. We have to ask ourselves, are these companies truly viable investments, or are we literally looking at a meticulously marketed house of cards?
Okay, let's dive into this. To really understand the sheer, unprecedented scale of the capital these companies require, just look at OpenAI. $600 billion. That is their projected compute spend by the year 2030. That is an astronomical figure. They are quite literally burning through cash in what can only be described as AI money furnaces. They are scrambling for capital right now, and the public markets? Well, we are their next massive faucet.
So to figure out if this is a golden era of investing or just the peak of a terrifying bubble, we're going to systematically evaluate this risk dossier. We'll hit the AI IPO gold rush, dissect those sky-high valuations, unpack the systemic risk of market concentration, analyze the very real threat of high interest rates, and finally ask a really uncomfortable question. Are you simply acting as exit liquidity?
Section 1. The AI IPO Gold Rush.
The sheer size of the offerings coming from companies like SpaceX, Anthropic, and OpenAI is poised to completely shatter recent market records. I mean, look at the scale here. SpaceX is looking at raising at least $75 billion. Anthropic, which is actually on track to see some profitable operations, is valued in private rounds at an eye-watering $965 billion. And OpenAI isn't far behind at $852 billion. To put that into perspective, these three companies alone are set to raise more money by going public than all other US IPOs combined since at least 2022. And keep in mind, aside from Anthropic's recent quarter, we are mostly talking about massive, completely unprofitable operations.
Now, what's really interesting about this is the actual pitch being made to investors. Take the SpaceX IPO prospectus, for example. You'd expect dry financial projections, right? But instead, it reads literally like a science fiction novel. They're actively advertising the company as a bet on Mars colonization, asteroid mining, data centers in space, and human augmentation. By their own admission, the technology for a lot of these things is either totally unproven or just straight up non-existent.
In fact, right there in the official financial document, the one meant to help investors make sound economic decisions, we get this grandiose mission statement: to extend the light of consciousness to the stars. Okay, profound? For sure. But as a financial analyst, I have to ask, how exactly does extending the light of consciousness pay a quarterly dividend? You really have to juxtapose these sci-fi promises against the harsh reality of trying to find solid, tangible financial returns.
Section 2. Dissecting sky-high valuations.
And this brilliantly illustrates a massive disconnect in the market right now. Shifting our focus directly to the balance sheets, SpaceX is essentially hitting the market with a price-to-sales ratio of over 90 times. 90! Contrast that with profitable, established tech giants who also have massive AI businesses, like Google and Meta. They trade at a price-to-sales ratio of around 10 times. A 90x multiple means this company is priced absolutely perfectly for perfection. There is zero room for error.
Usually a rich valuation like that is justified by explosive world-changing growth, but the numbers just don't support that narrative here. SpaceX's AI segment, which revolves around Grok, grew just 12.5% year-over-year in the latest quarter. Actually, scratch that. It's not even the fastest-growing internal segment of their own business. Furthermore, despite claiming 93% of its massive total addressable market is going to come from enterprise AI applications, their current enterprise use case was recently described as little more than a glorified Google Translate.
Section 3. Market concentration, systemic risk. Zooming out to the broader macroeconomic picture for a second, the S&P 500 is incredibly top-heavy right now. Nearly 40% of the entire index is concentrated in just the top 10 tech stocks, and the vast majority of those are heavily tied into the AI ecosystem. The broader market is already precariously balanced on the shoulders of tech. So injecting these new massive, unprofitable AI valuations into indices, it leaves almost zero margin for error. So the crucial point is understanding what systemic risk actually means in this context.
If these AI companies are priced for perfection and the tech fails to live up to its sky-high revenue expectations, an AI bubble pop wouldn't just hurt a few speculative tech bros. Because these stocks get fast-tracked into passive index funds, a correction would ripple out and absolutely devastate everyday retirement funds and 401ks across the board.
Section 4. The interest rate threat. We also absolutely have to look at the macroeconomic environment. Treasury yields are currently floating near that 5% level, while the S&P 500 sits at a price-to-earnings ratio of around 31 times. This is incredibly important. High, risk-free interest rates actively discourage stock market investing, especially the highly speculative, cash-burning kind of investments that these AI businesses desperately rely on. Think about it. Why take a massive risk on an unprofitable company's future potential when you can get a guaranteed 5% return directly from the government?
And borrowing that money is getting really expensive. Look at this staggering contrast in OpenAI's finances. A $600 billion projected compute spend by 2030 set against just $25 billion in annualized revenue. That is a gigantic looming chasm. They either have to borrow at these high rates, or they have to massively dilute shares to fund this incredible deficit.
Section 5. Are you exit liquidity?
Let's move to and see how this builds into a really important question for you, the viewer. Why are these incredibly expensive, capital-intensive companies suddenly marketing so aggressively to everyday retail investors? Brokerages are radically lowering the barrier to entry to pump individual investor money into these offerings. Look at Fidelity. Normally, to access a traditional IPO, you'd need $500,000 in capital. For the SpaceX IPO, they dropped that requirement to just $2,000. That is an unprecedented effort to get smaller investors into the game. But why?
Well, when you look at the fine print, several major red flags emerge. First, SpaceX reserved up to 30% of its shares for individual retail investors. The typical amount, just 5 to 10%. Second, nearly $1 billion of insider shares are unlocking within the next couple of months, meaning early private investors can finally sell their stock to the public. And third, despite bringing in all this public money, Elon Musk will retain 85% of the voting rights. Systematically, all of this evidence strongly suggests that democratizing access might actually just be a clever strategy to use everyday investors as a massive source of cash, allowing early, private insiders to jump ship and cash out right at the top of the hype cycle.
Look, the technological revolution of AI is undeniably real, and the feats these models are achieving are genuinely impressive. No one is debating that. But as an investor, you have to separate the visionary promises from the brutal financial math. When companies are priced for absolute perfection in a high interest rate environment, you are carrying an immense amount of risk. So I'll leave you with this one final thought to consider. When you buy into these record-breaking IPOs, are you really investing in the future of human consciousness, or are you simply acting as exit liquidity for billionaires? Thanks for joining me on this explainer, and remember, always look past the hype and check the balance sheets.